You cannot have long-run maximum employment with inflation. They need to get inflation down, have confidence that inflation will stay down. Then employment should stabilize. High inflation causes greater uncertainty. It's a tax. It will slow the economy. And in time, yes, it does make the employment picture more difficult to maintain.
I'm honored to welcome back Thomas Hoenig. He was the president and CEO of the Kansas City Fed from 1991 to 2011, and he later served as the vice chairman of the FDIC. He's currently a distinguished senior fellow at the Mercatus Center at George Mason University, and he's worked for the Federal Reserve for almost 4 decades as an economist and senior economist in banking supervision. Welcome back to the show, Mr. Hoenig. It's good to see you again.
Thank you. Thank you.
I'd like you to first comment, please, on the recent volatility we've seen over the last week. Certainly, some fears have died down since the high spike in the VIX to 60 last Monday. Immediately following that day, there have been calls for the Federal Reserve to issue an emergency rate cut before September. I wonder if that's still something to consider. They have 4 weeks left, I guess, to make this cut if it were something to happen.
Well, I think that would be unfortunate. I don't think we have an emergency right now. And I think that the market's volatility is a reflection of the Fed's past willingness to intervene very quickly. If you think about it, for the last 8 months, the Federal Reserve has been promising to make a rate cut. That's, for the market, the speculators in the market, that's a one-way bet. So I think you got you got a bubble going over the last several weeks. And last week, that bubble was pricked, and you had some real increase in volatility, uncertainty, fear, and the call for the Fed to do something again. And I think the markets need to learn to take care of themselves and to put their investments in there accordingly and know that there's risk on both sides of that. So, no, I don't think there's any need for intervention anytime soon. And number one. And number two, if there was a call for it, I think you would look to the real economy to see what's going on there. And at the moment, while the facts of the matter are the economy is slowing, but that was the purpose of raising rates. So the economy has slowed, but still, with that, given the amount of fiscal stimulus that's been in the economy for the last several months and years, the economy is doing, in all respects, okay or better than okay.
We'll talk about the outlook for the economy in just a bit. But going back to the Fed rate cut, now it's been argued whether or not the Fed should act anytime there is any financial volatility. Should the Fed have a third unofficial mandate, Mr. Hoenig, of preserving financial stability?
I think preserving financial stability is a long-term assignment. I think managing day-to-day volatility or managing one-day events that are a result of say, asset bubbles is not its mandate. The markets are supposed to manage their positions, understand their risk, and invest with the knowledge that they could lose, not that the Fed will bail them out. So I'm not at all inclined to have the Fed start intervening at every turn and twist in the market. I think it's very unhealthy for the economy.
What about stress in the banking sector? If the banking sector does see more stress, and if economists argue that perhaps we need lower interest rates to alleviate that stress, should the Fed act, even though perhaps the economy itself may still be chugging along just fine or okay?
I think for those institutions, if there is a liquidity crisis, then I think there is a role for the Fed. But let me start with number one. The banking industry, like the economy more generally, should be responsible for itself. And if every little twist means the banking industry is in trouble, it means you don't have enough capital. So while they fight increases in capital, which is their prerogative to do, I don't think they then should turn around and expect the Fed to bail them out if their asset values are under pressure. That's not the Fed's role. The Fed's role is, if there is a liquidity crisis, to provide liquidity to solvent well-run institutions, not to institutions that are on the verge of failure or serious need to raise capital. That's not the Federal Reserve responsibility. So no, I don't think the Fed should be ready to step in at every turn. It's just really bad moral hazard, in an invitation to moral hazard and bad outcomes.
I like to show you this chart, Dr. Hoenig. Every recession followed a peak in the Fed funds rate, according to this chart here. This is courtesy of Rosenberg Research, and it shows the Edinburgh designated recession gray bars following a rate cut in past cutting cycles. So my question is, if the Fed were to cut interest rates by September, which is what the markets expect, could that be a signal for economic weakness? Could that be actually a trigger for more panic?
Well, I think that's, for me, hard to say. I first of all, I would point out that usually those rate increases come after a recession begins, and then it continues on. And what the Fed has gotten in the habit of doing over the period that you showed there is that when they lower the rates and the economy starts to recover, even the Fed says, well, we want to make sure it stays in a recovery mode, and therefore we'll delay any normalization of interest rates. So you see these cuts come on down, and then they literally are well after the recession ends. I mean, one of the biggest examples of that is following the 2008 crisis. The recovery was the economy was in full recovery in the third quarter of 2009 and beyond, and yet in 2010, the Fed engaged in a new round of quantitative easing, which actually, I think, was a mistake. And so I think you do get the sense then that if the whole attitude or the understanding of the markets is that the Fed will always intervene and do so aggressively, even as the economy recovers, that chart would make sense, but it's not necessarily good policy.
This is a quote from JP Morgan CEO Jamie Dimon. Last Wednesday, he said that the odds of a soft landing for the U.S. economy are around 35 to 40%, making the recession the most likely scenario in his mind. This is according to CNBC. He said there's a lot of uncertainty out there. I've always pointed to geopolitics, housing, the deficits, the spending, the quantitative tightening, the elections. All these things cause some consternation in markets. He said that he's a little bit of a skeptic that the Federal Reserve can bring inflation down to 2% because of future spending on the green economy. So before we talk about the outlook for inflation, can you just address some of his concerns out there regarding deficit spending, quantitative tightening, and ultimately whether or not a recession this year is the most likely outcome?
Well, first of all, in his remarks, I mean, obviously, he's correct. There are a lot of uncertainties in the economy. I don't know that that's necessarily new. I don't think that's necessarily something that the Federal Reserve can take care of. International events, by lowering rates, those events are going to happen regardless of what the Fed does, and they will have an impact on confidence. So, yeah, I agree with him that those are major issues. As far as a recession goes, I don't have the answer to that. I would think that you are having a slowdown in the economy. That was the intent of raising the rates. The Fed does not want a recession, but the fact of the matter is there's always that risk when you raise rates as aggressively as the Fed did. And now you have the Fed, I think, in a quandary itself. The rates have been higher than they had been for years. They were that way, and then inflation did come down from a historically high 9%. And the Fed began to talk about interest rate cuts, I think, prematurely. They talked about them when inflation was still well above 3%. They talked about rate cuts when inflation was 3%. And they're still talking about rate cuts when inflation is 3%. We'll see what inflation is later this week, perhaps, in terms of the CPI. But I think they have a ways to go before they should be announcing that they're going to cut rates. Now, if they're going to do that, then what they should be saying is our goal, as the chairman has said, but he has to say it without promising future cuts, is that inflation has to be down to 2%. We will talk about rate cuts when year-to-year inflation rates are headed clearly towards 2% from their current level. And then the market can make its own decisions, how much liquidity it needs, how it's going to react to the fact that they still have inflation at 3%. Because remember, behind that is fiscal expansion that is enormous. The debt, the fiscal deficit this year will be $2 trillion or more. That has to be funded somehow. And if that's the case, then that'll put upward pressure on either inflation or higher interest rates or both until the inflation number is brought down and the economy slows to where you have an ongoing inflation rate of 2%.
How would a fiscal deficit, a larger deficit, translate to inflation? Are you assuming that the Fed is going to monetize some of this debt, or are you assuming that the spending will just trickle down into the economy itself?
I think all that. Number one, the spending will trickle into the economy, creating demand. We still have fiscal policy that are stimulating to infrastructure, to green energy, to make some parts of manufacturing construction for chip technology. That puts demand into the economy. In addition to that, you have the Fed. If the debt continues to grow as it borrows from the public, if the Fed does not monetize the debt, then that puts upward pressure on interest rates, and that'll put additional pressure on the Fed to monetize the debt. Monetizing the debt will, in fact, keep inflation rates elevated, and that's a problem.
Well, I remember when I had you on my show a couple months ago, I asked you if you were still part of the FOMC, you would vote for a rate cut. At the time, you said,
I at the moment, looking at the economy and where interest rates are and where inflation is, I certainly would not be voting for a cut. I would be, because I think it's steady state. So you're not going to get a major reduction in inflation unless there's a banking problem or big increases in productivity. And so I'm not willing to accept 3% inflation. Inflation needs to come down to 2%. So I would certainly not cut at this point.
Do you still stand by that now? I mean, have things changed now? It's pretty much baked in the cake, I would say, that they would cut by September unless something changes. But what's your opinion? Should they still cut?
Well, number one, I think that, like you say, they've pretty much announced, or the markets to say there'd be a rate cut. They haven't promised it specifically because they're still putting the caveat in there, assuming inflation comes down. So I would be reluctant to commit to a rate cut until I see next week's inflation numbers and month-end inflation numbers with a PCE. And I would also be careful in terms of I would not be lowering rates unless clearly the year-over-year inflation rate showed significant progress again between now and the next FOMC meeting. And I don't see any necessary guarantees that inflation will come down that sharply at this point.
The unemployment rate climbed up to 4.3% with the latest reading. At what point do you think the Federal Reserve will need to start prioritizing the labor market, perhaps over inflation? I
don't think it should. I think you cannot have long-run maximum employment with inflation. So there would be a false trade. They need to get inflation down, have confidence that inflation will stay down, and then employment should stabilize. And if it doesn't, and if inflation is falling, then of course they can lower rates at that point. But I don't think they should be driven by the unemployment rate. 4.3% is still a fairly historic low rate for any sustainable period. It's very impressive. And I don't think that we need to be talking about if the unemployment rate gets to 4.5%, that we have to cut rates if inflation is still at 3%. Because if they do, they're going to have inflation, they're going to be feeding inflation. And over time, that will actually make the unemployment levels tend to get higher as instability and uncertainty follows the inflation numbers.
Does high inflation cause layoffs and unemployment as well, just generally speaking as a principle?
High inflation causes greater uncertainty. It's a tax. It will slow the economy. It causes people to have to ration more aggressively. So it does hurt the economy. And in time, yes, it does make the employment picture more difficult to maintain.
Okay, so ultimately, Dr. Hoenig, what do you see is the likely path for inflation?
Well, if the Fed keeps its rates where they are, which are mildly restrictive, think about it this way: the Fed funds rate is 5.3% effective rate. Inflation is 3%. Real rates are 2.25% to 2.75%, depending on whether you use the CPI or the PCE inflation deflators. That means you have a mildly restrictive. If the inflation numbers come down and stay down to where the real interest rates are 2%, then you have a fairly stable environment where that can maintain inflation around 2% and the economy growing real wise in the 2% plus. So yes, the interest rates have come down as inflation comes down and stays down. But I tell you, I would not see the Fed funds, the nominal Fed funds rate should not fall below 4% anytime in the next several months or a year.
Is there an equilibrium rate for you that could target a Goldilocks scenario where we have reasonably low inflation and reasonably low unemployment as well?
That would be 4%. Okay. Nominal Fed funds rate, because then you're assuming then that the inflation rate is 2% and that the growth, the equilibrium rate of interest real rate is 2%. That substantiates a 2+ growth rate in the economy and about around 4% or a little higher, say below 4.5% or so of unemployment.
Okay, I'd like to play for you this clip of Donald Trump during his press conference at Mar-a-Lago. A reporter asked him about the Federal Reserve. Take a listen to his response.
Well, look, the Federal Reserve is a very interesting thing, and it's sort of gotten it wrong a lot. And he's tending to be a little bit late on things. He gets a little bit too early and a little bit too late. And, that's very largely it's a gut feeling. I believe it's really a gut feeling. And I used to have it out with him. I had it out with him a couple of times very strongly. I fought him very hard. And, we get along fine. But I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful. And I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman. Yeah.
Should the president have a say in the in monetary policy?
I think that the president by himself should not, but that doesn't mean I propose that the Fed should be able to conduct monetary policy as the law now reads in somewhat of in an independent manner for the short run. But I also agree that there should be legislation. If the Fed is going to change its operating procedures and its policy dramatically in a short period of time, then it should take legislation passed by the Congress, signed by the president, to engage in significantly changed policy. And I'll give you an example. Quantitative easing was a major change in how the Fed conducted monetary policy. Huge change. Massive printing of money in an effort to stimulate the economy. It had all kinds of consequences. I think in the emergency in 2008, the fact that it provided enormous liquidity was justified, and that's how it was set up, to have the flexibility in a short period of time to do that. But to continue it then for years after that, as they did in 2010, 2013, 2019, 2020, there should have been a requirement that new procedure, that new tool called quantitative easing, should have been approved by Congress, and then the bill signed by the president. So yeah, I think in the sense of major changes, in a democracy, that requires approval. In the short run, when you've delegated that to the Federal Reserve in this instance, it should be able to exercise that authority, but that authority was exercised as a liquidity into the market for solvent institutions, not for major changes in its policy tool like quantitative easing.
I'd like to point out this theory that's circulating on Wall Street that the Treasury is manipulating interest rates to possibly curry favor for the Democrats. This is a New York Times op-ed. I just like to show you the a few paragraphs here. There's a story going around Wall Street that the Treasury Department is trying to help Democratic candidates in November by how it issues debt. I don't buy it, says this author. Here it is. The story is that the Treasury, which is responsible for raising money by selling interest-bearing securities to investors, has kept a lid on long-term interest rates to stimulate economic growth and the stock market in an election year. The Treasury is manipulating interest rates, the story goes, by selling relatively fewer longer-term securities, such as 10-year Treasury notes and 20-30-year Treasury bonds. Investors competing for the limited supply of those long-term securities accept lower yields, so interest rates fall. The claim is that the Treasury is overly tilting its debt issuance to bills which mature in a year or less. That doesn't have much effect on short-term interest rates, which are more heavily influenced by the Fed's monetary policy. And it goes on to later say that what the Treasury may be doing is equivalent to quantitative easing by the Federal Reserve, and which counteracts the Federal Reserve's quantitative tightening program right now. Can you comment on this?
I really can't. I don't know. I mean, conspiracy theories come out from everywhere on these signs. I don't know what the Treasury's motives are. They have not issued long-term bonds to any great extent for some time. I don't know that it was what the motives are. So no, I couldn't guess. That would be guessing. And like I say, anyone can float an idea like that.
The Treasury General Account, which is the government's checking account, the government usually has more than $500 billion in the account, according to the article. It ran the account down to $23 billion in June of last year because of Congress's delay in raising the debt ceiling, and they've been restocking the Treasury General Account ever since. Has that made an impact on the long end of the curve, do you think?
Not necessarily, because it means that a lot of this money, they're like you say, they're building their account at the Fed. That's taking reserves out and holding them there. That has its own effects, but I don't know that would be. I mean, that would affect the interest rates. It could certainly, but I don't think it's because they're trying to manipulate anything. It's because they need to have accounts a large enough balance, like any checking account, to make payments and to fund it during interim periods of floating new debt. So I don't see anything there that's unusual.
Can you maybe comment on when you were at the Federal Reserve, if there were any actions taken by either Congress or the Treasury that may counteract what the Fed was trying to do at the time? In other words, if, let's say, the Federal Reserve was trying to engage in a tightening monetary policy, if issuing debt perhaps made that more challenging?
Well, it's always challenging, and that's one of the things that the New York desk and others do in the Federal Reserve, and that is try and anticipate what balances the Treasury will have, anticipate what the effect of their debt issuance will have, so that they can target the Fed funds rate towards their goal. So that's not unusual. It's not anything to be suspicious about. It is how it operates on a day-to-day basis.
I want to draw your attention to this chart in particular. Chapter 11 filings reached the highest level in more than a decade. And the question is whether or not Chapter 11 bankruptcies are a leading indicator for any sort of credit crisis or liquidity crunch. Have you seen any evidence of that?
Well, I mean, obviously, an increase in bankruptcies is a reflection of the economy, right? And the economy has been affected by the higher interest rates to bring inflation down. And what you do then is companies that are on the margin, what used to be called, the risk of zombie companies, they're wiped out, and that's probably healthy for a capitalistic system. And I don't know that it's necessarily bad. It certainly reflects a slowdown in the economy, and it also, as I said to start with, whenever you raise rates to slow the economy, you have a greater risk of a recession. Doesn't mean you're going to have one, but you have a greater risk of recession. And I don't see anything, again, abnormal about the fact that you'd have bankruptcies increasing.
Can you maybe comment for the audience once more what these vulnerabilities are that the banks face today? Keep in mind that last time you made that comment, right after that comment was made, another bank had failed.
Well, I mean, the vulnerabilities are, first of all, the banking industry has a large stock, if you will, of loans in commercial real estate. And now there's all kinds of commercial real estate. There's owner-occupied, non-owner-occupied construction, but they tend to be longer in duration, that is longer term, and they their values tend to decline when interest rates rise. So commercial real estate is a vulnerability for the banking industry. And that is particularly true for regional and some community banks. That's number one. Number two, when you have an economy slowing, you show the graph of bankruptcies. Commercial and industrial loans become more risky in that period because interest rates rise. Greater part of the revenues that those companies are bringing in have to go to pay the interest on adjustable rates that they might carry on their loans. So that makes them more vulnerable. The other part of it is the largest banks have a great deal of off-balance sheet commitments for letters of credit, lines of credit, derivatives. And these are liquidity risks. Should suddenly something happen in the economy and demand be made on these largest banks to meet their letters of credit and their lines of credit and whatever. So those are all risks in the economy, and they do elevate when the Federal Reserve puts policy in place to slow the economy. And I think the Federal Reserve is well aware of that. And that's why I think it's important for the banking industry to be able to show the public that they have a strong capital base in which to absorb these stresses in the economy without a crisis.
I'd like to share with you a clip of Kamala Harris at a conference. This was a few months ago before she was the Democratic nominee for president. Just take a quick listen to what she's talking about here in regards to community banks.
So like you said, Steve, when I was in the United States Senate, I actually was responsible with a group of other senators for getting $12 billion more into our community banks. So the importance of community banks is they are, as they are called, they're in the community, led by members of the community. They are people who understand the capacity of the community, the needs of the community, the culture of the community. They are folks who, unlike the big banks, will see the dream that an individual has for what is possible. And instead of rejecting that dream because maybe it's something they've not heard before, they will listen to it and then give folks advice, including financial literacy advice, helping people know how to run a payroll, how to deal with inventory in a way that they can start a business and sustain that business and grow that business.
Maybe just address what she said. How important are community banks to actually growing local communities?
I've never heard anyone disagree with that statement. Certainly, I think that community banks are important for smaller firms, small businesses, consumers. I think they have played a very significant role in the U.S. economy historically. And I think one of the advantages of the U.S. banking system has been we've had large banks that serve major corporate needs in this country and internationally for that matter. We have regional banks, both large and smaller regional banks that meet a mid-tier clientele, providing loans to them, banking services, payment services, letters of credit that have helped those companies manage their own business and be successful. And then we have community banks. Community banks help a great deal of small businesses. In fact, they make a major portion of small business loans. They make a major portion of owner-occupied real estate, for example, and serve that need within markets and communities well. So that's been the U.S., I think, absolute advantage over other parts of the world. They have a banking system that meets a variety of size and type of borrower needs. Other countries have much more concentrated banking systems with 4 or 5 banks, and they serve a much more narrow clientele. Therefore, credit is less available by that fact. So, yeah, community banks are very, very important to this nation.
To my understanding, there used to be a lot more banks in the U.S. over several decades of constant consolidation. There are now fewer than there were maybe 30, 40 years ago. Do you think that trend will continue?
Well, just to give you an idea, in I think 1980, there were about 14,000 banks. Today, 4,300 banks. So, yeah, there's been a major consolidation. That reflects all kinds of causes. One is most states in the middle part of the country were unit banking states. So you couldn't have branches, you couldn't consolidate. So once those laws were changed, you had consolidation. Number two, you have technology that makes economies of scale very much more germane to a bank's future. And so you've had consolidation to build scale. Those are a couple of reasons for it. And thirdly, and this is the unfortunate part, bank regulations are enormously burdensome. I've always said that laws and regulations should be simple, understandable, and enforceable. And Dodd-Frank, for example, is neither simple nor understandable nor enforceable. And you get really bad outcomes. That puts a major regulatory burden on the industry. Well, who's that going to hurt most? It's going to hurt the community bank because they have fewer assets to spread that fixed cost over. So I think that has those factors, and especially notable as regulatory burden, has encouraged the consolidation of the industry to its current size. Now, looking forward, it will continue to encourage consolidation. To what level, I don't know. It depends on so many factors, but it certainly will be a pressure for consolidation.
Okay, let's assume that this trend of consolidation will continue. Is it going to be more difficult then for small business owners in the future to acquire capital? Is basically the fabric of small business, which is a majority of the GDP of America, is that going to change if we have fewer community banks and more larger banks operating in these communities?
The answer to that is yes. When you reduce the supply of anything, the price tends to go up and becomes less available. I think the other part of this is that, and back to the regulatory burden, the entry into banking is far more difficult today than it was 20 years ago even. And I'll give you an example. Prior to 2010, Dodd-Frank, the average number of banks, new banks coming into the banking industry averaged around 150 a year per year. Now they're down to less than 10 per year. So you're reducing the supply of banks in the market and the loans that those banks would otherwise make for that particular line of business. And I think that's harmful in the long run. Yes.
Final question, Dr. Hoenig. Do you think there should be regulation to cap the number of consolidations made in the banking industry, which is to say that there should be a minimum number of banks below which it would be considered an oligopoly or a monopoly, and perhaps there would be antitrust issues?
If you try and regulate from that point, you will encourage consolidation to the point of that number. What I think there should be enormous pressure put on the Congress, number one, and the regulators, number two, to simplify the regulatory rules and the regulatory burden and to encourage entry for qualified applicants to own and start new banks, because it's a free market works best when there's entry and exit. Bad banks leave or consolidated, new bankers come in and refresh the supply of lending through the new banking charters that can be made. That would be the healthiest thing for banking in the United States.
Dr. Hoenig, I greatly appreciate your time, spending time with us today. Where can we follow you, perhaps learn more about you, your work?
I write with my colleagues at the Mercatus Center on what's called a blog that we call FinReg Rag, which is a means for us to communicate broadly. It's easily accessible under that title, FinReg Rag, number one. And then I also write for Mercatus's public newsletter, which is called the Discourse magazine.
Okay.
Always happy to read it.
We'll put the links in the description down below, so make sure to check that out. Thank you very much. We'll speak again soon, Dr. Hoenig.
Glad to be with you, and thanks for having me.
Thank you for watching. Don't forget to like and subscribe.